In my previous video, I got the question if I could analyze Alibaba. Of course I can. Let's go and head in. So we are going to take a look at Alibaba Group, ticker symbol BABA, which you can see on eToro. If you would like to get more information, feel free to check out the description of this video. And if you would like to have your stock analyzed, just type it into the comment section and I will make sure to make a video of it if I can. So we are going to head into the Tune for Dividends Excel sheet where I already plugged in ticker symbol BABA and I got most of the informations which I'm going to go through in this video. Alibaba is a huge group located in China, so analyzing a Chinese stock is much more different if I would do an American one. So if you would like to compare BABA with Amazon, you could sort of, because they have different market segments but relatively close to each other. But I wouldn't go there because it's just a little bit different world. So valuing a Chinese company is much more different than I would value a US company. This could have political reasons or this could have different accounting measurements. But in general, we are going to go through the main things and we were trying to get let's say the value of the company, if it's worth to buy, if it's worth to hold for the long term. So for the basic informations, we can see that their price to earnings ratio is 14.58, which is quite good for a growing company. Let's just say like that. And we are going to actually see the 10-year past informations. If we open up this ratios tab, we can see that their current P ratio is quite low. They were trading before on the 40s, 35s because they were a fast-growing company, and they're actually still a fast-growing company. Just before we head in, let's look at their profit margins, which is about 11%. It's great. Alibaba Group in general is hard to analyze because you have a lot of segments in the company. You have the commercial and then you got the cloud services. So it's a very complicated structure of the company. So we are not going to take each part. We are going to focus on the main concept of how they are actually profitable, what is their free cash flow. And their current ratio is about 1.8. What is current ratio? It's the current assets / the liabilities, the current liabilities. 1.8 is a great number. Everything which is above 1 should be good. It shows that their current health situation is okay, and their debt to equity and their long-term debt per equity ratio is 0.14, which is extremely good. What does this mean? This means that the company actually has a lot of cash and low debt. So it's good in the sense of we will know that the company could be healthy. Of course, it's two different things. One is, okay, the company is great and healthy, and the other one is how is the market valuing the company. And I had Alibaba stock. I still have a few $1,000s, but not much. It's because I have generally realized that even though Alibaba is a great company, mostly in this current political structure, it is not going to be valued at the level I would like it to be. We had the news in 2021, 2022 that they even would like to delist it from the US markets. So I'm very careful. This is more a political thing than a valuation method. They pay a little dividend. I think this is something new they have just thought in 2024. It's okay for investors because you sort of get one-way appreciation for your holdings. So you're not just going to hold a stock that should appreciate in the stock value, but you also can receive some dividends. It's good. So return on assets is 5%. Okay, return on equity 10%, great. And return on investments is 8.2%. In general, it's great. And we can see that the earnings per share growth is negative. So year over year, I mean. So therefore, we will have to see that China is sort of in a different situation, market situation as other companies or countries actually. So if we would check the 10 years past revenue, we will see a huge increasing, especially from 2016. You can see that the company has been growing, and in 2023 and 2022 there is a general slowdown, and you can see in percentages as well that from 2021 and 2022 there has been slight slowings. Of course, there's still no 2023 in this Google Sheets. It's very important, but since I am not going to look in the actual price of the company because it would be very different than it actually is, I'm not going to look at it. So if we look at the 29th row, which is about the net income, how profitable is the company, you can see that the company is well profitable. So there is no issue on the profitability side. In the past 10 years, they have been always making money. And if we would like to see that how is their shares outstanding, especially the diluted version, we can see that there is a sort of starting of buying back shares. There was a bigger chunk in 2022 and also in 2023. So why is it good if a company is buying back shares? Well, if there is less shares out on the market, and if you're a current owner, that means there is going to be less shares outstanding, and that will push up your value for your holdings, so it's great. That's why Warren Buffett is looking always for share buybacks. And if you would look in the 39th row, we can see that their free cash flow is absolutely massive. And if we would do a simplified discounted cash flow valuation, which we can, there is no issue, we could get a great picture what could be the real value of the company in theory, but then in real life, it's much different. There are some investors who are speculating widely if the company is undervalued. I think it's quite undervalued if you look at the current price, although it's very hard to see the political outcomes of the next years, especially it's 2024 US elections, you never know. But if we go into the balance sheet and we look at how safe is actually the company, you can see that they have been building cash positions for a long time. They are massively having cash in their accounts, which is good. Why? They can buy back shares, they can give you dividends, and they can also develop the business through R&D. So it's not a problem if a company has a high cash level. Of course, it's good if a company can reinvest it and then, focus on their growth, and on the other hand, pay out dividends and buy back shares. So we can see that their total debt is not that big at all. So if they would like to pay all their debt, they can just say, look, we're gonna pour the cash to the debt, and then we're not gonna have any debt. But it's okay to have debt, because sort of you get the cash and then you can use it for investments, research and developments, or financing anything. So in general, the company is in a very, very healthy situation with a low valuation, but with a not like, I can't say it's not stable, but a sort of hard to say political situation. So for this reason, I understand if someone thinks that Alibaba is undervalued. I understand that someone would like to look at from the value investing perspective and say, okay, I'm going to buy shares of Alibaba. But I also have to say, look, maybe the political situation is not correct right now. It could change in the future, but I don't really want to speculate on it because it just seems so hard for me for my situation. And what I want to do as a last thing is to compare the returns of Alibaba as an individual company versus the S&P 500 total return versus total return. So in this case, we would see that the 1-year track record of Alibaba was negative. This means if you would have invested in 1 year from this, then you would probably, you would actually lose money, or not lose money, but you would lose money on paper. But if you would have invested in the S&P 500, you would have a not realized or realized 28% growth. Is amazing. And if you would look at the 5 years, you get a much worse situation basically on the stock price. But if you would take the 10 years and just forget that there has been 2021 and travel back all the way, you could see that the company was actually glowing in 2017, where actually, interest rates were very low, imports were lovely. And, in 2020, when the world was locked down, sort of the situation was not that bad for Alibaba, even though there were supply chain issues. And then 2021, basically, the disappearance of Jack Ma and all of these things have been negatively affecting the company's valuation. And basically, you can see that the current stock price is about the same as it was in 2015. And if you would just go take a look back on their revenues in 2015, it was, 8 times smaller than the current one. But if we look at the profitability, you can still see that the profitability didn't change. So the company could get a much bigger market, but their margins have been decreasing in that aspect. And if you look at the price to earnings ratio in the past, let's say 2015, there was 17, and then 2026 was 42. That means that the company's stock price was increasing, and maybe their revenues were not following it as fast as the stock price was growing. So basically, we are in a picture that I would say the company is in a very hard political situation. It has a stable balance sheet with a lot of cash, relatively low debt. And basically, I don't know, I can't control politics. I have an opinion about it, but I can't change it as of now in this chair, for sure not. So let me know which stock you would like to get analyzed. Let me know which stock you would like to get a picture of what could be the real value in actual dollar figure numbers. And don't forget to subscribe to my channel. See you in the next video, and check out the description where you will have links to access eToro. And let's see each other in the next one. Goodbye.